Hi, I'm Jimmy. In this video, we're going to look at the US economy. We're using a few different economic indicators to see if we can objectively gauge where the US economy stands today, and hopefully we can use this information to help us make better investment decisions and ideally get us closer to our goal of achieving financial freedom. And towards the end of this video, I'm actually going to share my opinion, my personal opinion, about the current economy. Usually I try to let the numbers do the talking for me, but I recognize that sometimes that can leave us wanting further thoughts. So after we tally up this scorecard, I'm going to share my personal opinion, and hopefully that will help guide people as to at least my answer to the question, should we invest now or wait for the stock market to crash again? Okay, so let's jump right in. So we're going to begin with housing starts. So this economic indicator is a measure of the number of new houses being built. The theory is that the stronger the economy is, the more houses that are being built. And the same is true vice versa, that if more houses are being built, in theory, end up with a stronger economy, thanks to the ripple effect that happens throughout the economy from a strong housing market. Now, I've gone back further in this video than I have in past videos. That way we could see what housing looked like before the housing bubble. And as we could see here, the number of houses being built before the housing bubble burst was significantly higher than it is today. Now, this may not be too surprising since during that same time period, the period that houses were going up very quickly and being sold fairly quickly, well, it was easy to buy a house back then. And that's at least part of the reason that the country ran into the trouble that it ran into. And the good news is that since the bottom of the financial crisis, or the housing crisis, whatever you want to call it, well, housing starts have gradually climbed. They've done fairly well for a long time. Even when COVID hit, well, there was an initial pullback, but then it recovered fairly well, which is pretty good for the overall economy. So to me, this is a good sign, and this should be a point for the bulls. So when we shift over to our scorecard here, well, now we give a point to the bulls. Okay, simple enough. Now we're moving over to the cousin of the housing starts, which is the price of existing home sales. Once again, we're going back to pre-housing bubble to get a bigger picture perspective of how things were as compared to how they are today. And we saw a decline in the price of housing, which once again makes sense since we know that there were less people buying houses and there were a ton of houses that were built. So falling house price during that time, during the bubble bursting, makes a lot of sense. But once again, the trend since then has been fairly good. Now, you might see those individual ups and downs during any given year. That's really just seasonality. Because, of course, buying homes during certain times of the year are likely to lead to higher prices since, let's say, less people want to buy a house during, let's say, wintertime. So you're going to get some seasonality, but overall the trend has been higher. And as we can see most recently, well, housing prices are once again increasing, and this is likely a positive sign for the overall economy. So I think it makes sense, again, to mark this down as a point for the bulls, since housing prices appear to be heading in the right direction. So far, this scorecard here, this is the same as it was in last month's analysis. But don't worry, we actually have a couple changes coming up. But for now, let's shift over to initial jobless claims. And I'm sure we could have all guessed that initial jobless claims does not look all that great. And yes, I'm thrilled that the weekly number appears to be heading in a lower direction. Now, I was curious how COVID compared to the financial crisis, also known as the Great Recession or the housing bubble, whatever you want to call it, 08, 09, that time period. This is the way that chart looks. So we can see that the current spike towers over the previous peak from the financial crisis. In fact, the worst week in the financial crisis, there were 665,000 new jobless claims filed. And if we switch back to the current, more short-term chart, well, we can see that the current number is 751,000 new jobless claims for the most recent week. And the peak was up near 7 million. Now, of course, COVID was a bit different, but overall, this is still a terrible thing. And just to keep this video moving on at a reasonable pace, when we switch over to unemployment, well, clearly 7.9% unemployment is also a very negative point. So this is going to be a negative sign for the whole economy. Now, if we're curious, unemployment at the peak of the financial crisis was higher than it is today. And it declined more slowly than it is declining right now. So there's got to be something to be said for that. But either way, when we switch over to our scorecard here, well, on the scorecard, I think it makes sense to give both of these points to the bears, since these are negative signs for the overall economy. Okay, now moving over to the Baltic Dry Index. the Baltic Dry Index tracks the cost of transporting raw materials. So generally, these are products that are used in the manufacturing process, and we'll come to manufacturing in a minute. But as we can see here, well, the Baltic Dry Index has recently dropped, and this is a negative thing. Now, the theory here is that as the prices fall on the Baltic Dry Index, as demand begins to fall. So we can see with the coronavirus, when that happened, there was a big drop in the Baltic Dry Index because there was very little demand since many manufacturing plants around the world began to shut down. So when we head over to our scorecard here, well, last month we actually had this as a positive point for the bulls. But since the Baltic Dry Index appears to be getting stuck at the lower end of the current range, frankly, it makes me a bit nervous. So actually, I think it makes more sense for this month to make this one a neutral point. So we got a point for the bulls and for the bears. Okay, now moving over to a related industry in manufacturing. This is the ISM Manufacturing Index. And basically, the most important level for us to remember with this index is 50. Anything above 50 implies that the manufacturing sector is growing. Anything below 50 implies that there's negative growth. So we want that indicator to be above 50, which it is right now. So at this point, it looks pretty good, and this is going to be a point for the bulls. Now, it's very possible if the Baltic Dry Index continues to get worse, that could be because one indicator is leading the other. I actually think the Baltic Dry Index is more of a leading indicator. So it's possible that manufacturing sees a pullback. But for now, just taking the data for what it's worth, I think that it makes sense to give this point to the bulls, since right now it looks like manufacturing is growing. Okay, so now we're going to look at the Fed funds rate, or really the Federal Reserve as a whole. So as we can see, interest rates are extraordinarily low right now, lower than they've ever been before. And this one's really a tricky one. I know I've said this before, but it's a very tricky thing to try to quantify, because are low interest rates a good thing or a bad thing? On one hand, low interest rates are very good because the purpose of lowering interest rates is to stimulate the economy. So we expect for that to happen. But on the other hand, if they are too low for too long, at what point is it a problem? Now, we can see that the Federal Reserve kept interest rates low for a long time after the financial crisis. And then the economy actually did okay. So that does imply the economy can survive down at these levels, but for how long? We had to return to it pretty quickly coming off of the previous very low numbers. So again, I hate to cop out of this one, but I think we're going to have to go with a neutral point here because I could easily make the case in either direction. Okay, now we're shifting over to consumer confidence. So last month, we had consumer confidence as a negative point. And I think we could keep it as a negative point if we wanted to. But I'm thinking that the more recent growth in consumer confidence, I think that consumer confidence is improving, and this might be a positive sign for the overall economy. So I think it's time for us to move consumer confidence from a negative point to a neutral point. Okay, so on our scorecard here, well, if we're looking at our scorecard, I would say that broadly speaking, it looks like the economy is fairly neutral. But in my mind, I'm actually quite nervous about the economy at this point, and quite nervous about the stock market. I recognize that there are some positive points about the overall economy, and that it's very possible that the economy keeps growing, albeit likely at a gradual pace. But it's possible that things take a nosedive, or at least the stock market takes a nosedive. This past week has not been a great week for the stock market, and it seems deserved. There seems to be a disconnect between the stock market and the current economic situation. Even if we want to say that this is neutral, why has the stock market done so well? That overall makes me nervous when it comes to from an investing standpoint. Now, to answer the question, do we invest now or wait for a stock market crash? Well, for me, I have to stick with what has been somewhat of my long-standing approach to this, and that is that I think it makes sense to continue to strategically invest. If it were me, I would not be going out. I personally won't go out and buy, let's say, a broad-based ETF, something like an ETF tracking the S&P 500, SPY, or VOO, something like that. I wouldn't go out and buy those right now because I think that the risk is high that the stock market, as in general, could pull back. But I do think it makes sense to continue to identify individual opportunities that could do well over the long run. So for me, that's the smartest place to invest right now. Of course, the exception to this is dollar cost averaging, which is when we consistently invest the same amount of money at a consistent period of time. So every month, every quarter, every year, whatever it is, we consistently invest the same amount of money over and over. To me, that makes lots of sense. And no matter where those investments are going, I would keep doing that. I think that's very smart in general. But if we're going to pick individual investments, I personally like the idea of picking individual stocks or perhaps individual sector ETFs that perhaps have a value perspective to them right now. Now, we might ask, does this type of analysis even work? Is it worth our time to do this type of analysis? Sure, it's interesting to look at, but does it really work? Well, I actually did a video where I performed that exact analysis, and I did this same type of analysis before the financial crisis. So at the very peak of the stock market, if we had done this analysis, then how reliably would this have guided us that things were bad or about to get bad? So if you're curious, perhaps that is a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end. I really do appreciate it. Thanks, and I'll see you in the next video.